Coming up in today's review, stocks finish mixed, Tesla breaks down, stock market yellow flags, Chinese stocks in a bull market, Bitcoin higher again, and oil rises after Ukrainian attacks on Russian refineries. So we're still getting a bit of mixed trading in this market. You can see that in the heat map today. Bright red coming out of semiconductors and what looks to be a bit of profit taking in the hottest sector in the market. Was a little mixed across the rest of the tech space. In the best performing sectors today, energy, oil and gas, along with financials having a good day as well. It was a narrow range day in the market. S&P 500 barely trading 25 points from high to low. Commodity related stocks to winners today. Gold miners, oil and gas coming out in front, while clean energy, semis and tech, the losing sectors today. And so we could be seeing a bit more of this defensive rotation. Now I've got the NASDAQ, semiconductors, healthcare, discretionary versus staples, growth versus value and momentum, all having short-term pullbacks underneath their 5-day moving averages. However, that isn't confirmed by volatility yet, as volatility is still downtrending on all time frames. And just looking at the S&P 500 daily chart, looks like this parabolic grinding uptrend higher is still intact, and that's confirmed by the S&P 500 equal weight as well. And volatility really low, holding ground under 14 on the VIX index. However, some of the previously most important stocks to the market have clearly fallen out of favor, with still the second largest stock out there, Apple, holding its short-term technical downtrend, and previous hottest stock, Tesla, breaking down today as Wall Street appears to turn its back on it, with another analyst slashing their sales and earnings estimates, along with lowering their price target. That's Colin Langan coming out of Wells Fargo, who said he sees too many headwinds to stay neutral on the stock. Going on to say Tesla ain't looking so magnificent. We expect volume to disappoint as price cuts are having a diminishing impact on demand. Lower deliveries and vehicle price drive our 2024 earnings per share estimate 32% below consensus. He's projecting 1.8 million deliveries in 24, which is pretty much the same amount of EVs they delivered last year, with them summarizing Tesla as a growth company with no growth. So it's clearly not good analysis coming out on the stock here. Not as bearish though as Wedbush analyst Dan Ives, who said the Tesla narrative is as negative as we've seen in the last few years, with Musk and Tesla getting attacked by the bears from all directions. The demand story for Tesla is more in stabilization mode heading to the rest of 24. Price cuts are moderating, battery cost reduction is showing strong cost efficiencies, and a Model 2 is on the roadmap for next year. So whilst we can never count out Tesla completely, Elon Musk has proved critics wrong time and time again. Even though the stock and story has suffered many setbacks in its 20-year history, it is still one of the most strongest brands in the world. However, technically speaking, price is breaking down in a downtrend, and just going out to the monthly chart, this head and shoulders pattern I've had drawn in for a few months now could be playing out. Got the middle of the neckline around 175, and we've lost that today, currently trading at 168.50 after hours, with a market cap of 539 billion, which still gives it a price to sales a bit above 5. Just switching over to General Motors, got a market cap of 46 billion, on annual sales around 170 billion, which gives it a price to sales of 0.25. Huge difference with Tesla. So Tesla could get cut in half, trade down to $80 a share, have $260 billion market cap. It would still be trading at a huge premium in valuation to General Motors if the market keeps viewing Tesla more and more as just an automaker, which can be justified since more than 85% of their sales come from selling EVs. And so that's why Elon Musk and the board has a lot of pressure and responsibility on them to keep convincing investors to pay a premium for the stock, keep them excited about the future growth, the story, new products, robotics, AI, full self-driving, home energy and more. Because otherwise, if we keep seeing some quarterly earnings misses like we've seen the last couple, then the market could keep giving up on the stock and story. And so we'll hear from them in 35 days. Otherwise, for now, the price is in a downtrend. And in previous markets, just going back a couple of years, if you had told me Apple and Tesla were in persistent technical downtrends, I wouldn't have guessed that the NASDAQ index would look like this, still on a parabolic uptrend. Just shows you the shift that's taken place in this market, with now the most important stock, NVDA, still holding ground in its uptrend and trading more than 21% above its 50-day VWAP, and the whole semiconductor sector still holding its technical price uptrend. You can see that in AMD, Taiwan Semi, and not really a semi stock but closely related, selling hardware that chips run on, supermicro computer, having exploded in price this year. Not only is the AI and semiconductor sector driving the US market higher, the US economy, and more so its stock market, has been a story of exceptionalism quite some time now. There's 4 charts to put that in context, with the US stock market having over 50% of the world's market cap, and it's pretty much been that way for about 50 years, except for briefly in the late 80s, from 87 to 89. Japan was the largest market, and it's only really China in the last 15 years that's expanded to become the second largest market in the world, but still nowhere near the size of the US stock market. Not only in size, but in valuation as well. Looking at the US market cap to GDP, currently a bit above 170%, close to all-time record highs. And that's almost triple what the rest of the world, excluding the US, market cap to GDP is at 60%. And then just looking at the market cap and absolute numbers, so US a bit above 50 trillion. Then you got all of Asia and 70 trillion. And what's really helped that is the United States' dominance in technology, a growth industry. And so for the last 15 years, we've seen growth absolutely outperform value by the biggest amount on record. We can see that here in the dark blue line, the spread of world value versus growth, with that pretty much being driven by mega cap tech. And the numbers are there to somewhat back it up. We can see that with dividends being paid out by companies to investors, expected to hit another record this year, after rising 5.1% last year to a record 602 billion, which is pretty much the same growth we saw around the world last year. Worldwide payouts rising 5% to an all-time high of 1.66 trillion. So US dividend payments is a little bit more than a third of all global dividend payments, which is a bit behind the US's market cap relative to the world, which is a bit over half. And looking at election year seasonality and the way this government is spending, not to mention AI hype, stock price momentum, the fact we could be looking at getting some interest rate cuts from the Fed in the middle of a roaring bull market, the forecast is we should finish higher again this year. However, we could get a correction in the meantime, with some yellow flags already out there. The first being one of the oldest technical analysis theories out there, Dow theory. And that basically says to have a confirmed bull market, we've got to have both industrial stocks and transport stocks breaking out to highs. And whilst we've got that in the Dow Jones Industrial Average, we don't have that in Dow Jones transport stocks. They're still tracking a bit sideways. Another interesting dynamic that's currently happening is we've got low volatility stocks keeping up with high beta stocks. Typically, in a roaring bull market, we see the more risky, volatile stocks advance ahead while there's a bit of a rotation out of the defensive low volatility stuff. However, they've been bid up as well. Also, the bull market for a long while now has been led by tech stocks, and typically the leading sector will really separate from the market as a whole. However, year to date, we've actually got the tech sector, looking at ETF XLK, pretty much in line with S&P 500's performance, so no longer breaking away to the upside. We've also got one of the most beaten down and hated assets coming into this year off to a good start as we near the end of Q1. It's Chinese stocks, which according to a number of gauges are back in a technical bull market territory after being in a bear market for over 3 years, as the government has implemented a lot of measures and stimulus to put a floor in their declining growth and stock market. However, a lot of people forget their GDP is still growing over 5% a year. It's just their capital markets are a lot weaker than the underlying economy due to a loss of global investor confidence and political interference, which the CCP have been looking to dial back and attract capital back into their markets. And even though technically speaking, looks like we did put in a double bottom in January this year on some big bullish divergences, some momentum thrusts higher, now clearly in an uptrend. Just going out to a monthly chart, there's still a lot more work to be done before we break out above this trend line, technically speaking, but also with investor sentiment still very bearish. A lot of people are not convinced, with many having declared China as uninvestable. And one of the biggest stark differences in Asian markets, just sticking on this monthly time frame, has been the outperformance of Japanese stocks, which recently just took out their all-time highs from 1989. Just staying on the monthly chart, looking at Canada's TSX, approaching all-time highs. UK FTSE still consolidating. German DAX has been on a bit of a run, along with Euro stocks as a whole, and the Aussie 200 just broke out to new all-time highs this month. So we've clearly got a bit of global equity breadth out there. It isn't just NVDA and semiconductor stocks holding up the whole picture here. We've got industrials, home builders, Japanese stocks, European stocks. These are all breaking out to all-time highs, along with a good rebound in the world's second largest market of China. And being an election year, like I said, the forecast is we finish higher. What could upset that whole narrative is if we continue to get some upticks in inflation prints, which is already looking like it's hit a big bump in the road, struggling to get below 3% and hit a 2 handle, which the Fed really wants to see to kind of give it the green light to go ahead start cutting rates. Well, we've got a bit of a modest bounce back in treasury yields, just kind of holding ground here on the 2-year above 460 and just below 420 on the 10-year. So right now, Jay Powell can't really cut rates as much as he wants to. He would face quite a lot of criticism if he were to do that anytime soon. We even got a billionaire hedge fund manager, Seidel's Ken Griffin, who would stand to benefit a lot from lower rates and cost of capital. He's even saying the Fed must go slow on rate cuts to avoid disaster. With him going on to say, if I'm them, I don't want to cut too quickly. The worst thing they could end up doing is cutting, pausing, and then changing direction back towards higher rates quickly. That would, in my opinion, be the most devastating course of action they could pursue. And I think he's right. Can you imagine if Jay Powell goes ahead and cuts rates in June and September in what will appear to be politically motivated to help the Biden administration? Then if, as bookmakers predict, Trump gets back into office, a few months later the Fed starts hiking rates again, you can imagine the political upheaval and criticism they'll face from those set of maneuvers. And even though we've got roaring stock markets, let's not forget a lot of consumers still have inflation as one of their top priorities of things they want addressed and that affect their day-to-day lives. And even though we've been getting some disinflation this last year and a half, what really affects people isn't the month-to-month change, but rather the embedded inflation they've experienced over the last couple of years. Because for a lot of people, their wages haven't moved up these last 3 years, but the cost of everyday necessities like getting groceries still 30% higher than 3 years ago. In addition to inflation, the other single most important issue to a lot of Americans going into this election has been the collapse of their southern border and the huge influx of illegal immigrants. At a time the government is spending more than $10 on protecting foreign country borders for every dollar they spend on protecting their own. And while this surge in immigrants can be helping the economy, it could also be adding to inflation because there's a lot more people coming in all of a sudden, chasing after the same amount of limited resources. And we can see that here. Ever since the Biden administration got in, the amount of border encounters has blown out from about 600,000 to last year's all-time record, a bit above 3 million people. And this year currently on track to outnumber last year as well. Not only that, we're witnessing the Fed change its tune and its whole structure of how it works towards a 2% inflation target. We heard that in Jay Powell's testimony to Congress, in which he pretty much said, I'm not sure we need 2% inflation. Translation, the new target's going to be 3% and we're pretty much already there, which means he's given himself permission to go ahead and start cutting rates soon, knowing full well and likely it's likely to pour fuel on the fire, cause a resurgence in inflation. Even if we do see that after November, it may not matter a lot for the here and now. And that could be why we're seeing assets like gold and Bitcoin break out, with the Fed and the government willing to settle with higher inflation, keep spending at records, allowing for debt to blow out. That just continually weakens the US dollar, in which all these finite assets are priced in. And so the US government should be a bit worried with Bitcoin and gold steaming ahead to new all-time highs. It's just a sign of distrust in the fiat currency, and the price action looks strong in Bitcoin, getting above $73,000 a coin today, and we've still got gold just sitting below all-time highs as well. Another risk to the inflation narrative and Biden administration is oil prices. After we got a surprise drop in crude inventories, first time in 7 weeks, not to mention what's continually happening in the Middle East and Eastern Europe, with Israel wanting to push further into the Gaza Strip, much to the dismay of the Biden administration, who wants them to show some restraint. And if they don't, we should expect to see more Iranian proxies counterattack, along with continually going after ships in the Red Sea, which is still happening on a daily basis. Not to mention, we've got a bit more aggressive Ukraine starting to bite back against Russian assets. We can see that today after they attacked Russian refineries by the way of drone strikes, extending a campaign designed to hurt Russia's most important industry, which no doubt will see a response from Russia as well, continuing to escalate over there. Not to mention more and more nuclear threats from Putin if the West keeps stepping up their support of Ukraine. And so this could spill over before the November election. And if Trump were to get back in, his goal would be immediate solution by way of negotiation and to try and dial down the chances of a World War III. And not to take sides at all. I don't want to get too political. And not saying one side is right or wrong, but to understand the Russians and Chinese and their point of view. You can imagine how the United States government would respond if Russia and China had installed military bases just south of the Mexico border and was backing Mexico's aggression into the United States. And if you can imagine there was an island just off the coastline of America, which shared the same bloodline as most Americans, and again the Chinese had come in there and backed their military development, then again you could also imagine the response from the US government. So my point is, the Russian and Chinese are not going to back down from conflicts right on their doorstep, and they're really not coming over to our doorsteps in the West and threatening us directly. However, like a lot of people know, just keeping a certain level of conflict as long as it doesn't boil over into a World War III. Benefits a lot of the military-industrial complex, keeping us in a constant state of war. It's kind of a form of money laundering from us taxpayers to the big military companies and their contractors, keeping the flow of weapons to all these foreign countries that we like to meddle in. Nonetheless, that's what's keeping a bit of a bid in crude oil futures here, just sitting below $80 a barrel today. And so the Biden administration will keep walking the line between backing Ukraine and Israel without trying to let it spill over too much that we see oil explode higher. However, just holding ground here around $80 a barrel is still not good for the inflation picture at all. Not to mention this strong rip in shipping and cargo rates we've seen over the last 5 months as well. Moving on to economic data, we didn't get much out today from the States. There's those crude oil stocks coming in lower than expected, same with gas. Tomorrow we'll get a look at PPI, Producer Price Index. That's a cost input into inflation, expected to increase 0.3% month over month. Also get a look at retail sales, expected to have increased 0.8% month over month, 1% year over year. Weekly jobless claims. Then going into Friday, we'll get a little look at some manufacturing and consumer sentiment. We're in the middle of a roaring bull market. However, Fed Fund Futures still predicting that Jay Powell is going to cut rates come June, and he's going to throw another one in there in September. Stock market still feeling really good, well and truly in the greed zone, and corporate insiders still happy to sell a lot of shares into this price strength. Whilst we've still got a lot of participation from investors, quite a busy Wednesday for the options market. 42.1 million contracts traded, 57% of them calls. Did see an unusual amount of put options in Tesla today, 4.89 billion, with the froth cooling down a little bit on the other hot names, but still pretty big for NVDA, 2.63 billion. Same with MicroStrategy, only a $25 billion stock, but consistently coming to the top of the option volume leaderboard. Not only that, we've still got AI related stocks ripping on volume. There's the stock NVIDIA invested in, SoundHound AI, up 24% today on huge volume, 160 million shares. Also got others like MicroCloud Hologram, Gaxos.ai, BigBear.ai, and others showing up in the price advances leaderboard today. And just a few other interesting charts before we wrap it up for today. There's the cannabis ETF, MSOS. We've had some good moves on the legalization front. Still haven't heard from the DEA yet. However, technically speaking, we look to be finding some support here, around $7.30 a unit. And some of these other hot stocks just kind of hanging in there as well, with Abercrombie & Fitch reclaiming its 50-day VWAP. And there's New York Community Bancorp bouncing up there today. But this looks like a non-event for the markets, and the big banks still grinding higher as well. Okay, there we have it for this Wednesday. Really small range day. 51.65 and S&P 500. To have a little bit of weakness in the short term for some growth areas, but nothing too much of yet. Still got low volatility. Overall market still in a parabolic uptrend, and why wouldn't it be? With the prospect of the Fed cutting rates in a few months, with nothing breaking, record low unemployment, that's just music to the bull market's ears. But this could all be setting the ground for a resurgence in inflation. However, if the Fed and government time it right, we won't be seeing those big upticks until after November. That's all I got for you today. Thanks very much for tuning in to the Click Capital Daily Market Review, and I'll see you again tomorrow night. Cheers.